I was in some large hedge funds that probably people know about, and then I kind of converted it to a family office, semi-retired, and then I started investing in crypto, mainly Bitcoin, in 2014. And then in 2017, when the ICO boom happened, it really, really hit me that utility was potentially on the come. And I thought we could create security tokens, literally tokenizing the private shares of the time. That was Uber, Airbnb, and Lyft. And I thought if you can do that in a compliant way with an ATS and dealing with the SEC and FINRA, you can actually provide access to individuals. Because really, if you wanted to get access back then to these private shares, you had to go through the VCs if you can even get access to that. So that was my foray into it. And then Avalanche was a place that I saw, it came out of Cornell University, and it was a place that I realized the technology was so innovative that it can actually solve some of the tech issues. And that led me to being here. It's been 3 great years, president of Avalanche, the team behind Avalanche, and glad to talk about anything you guys want.
Yeah, so that's a good place to start. What makes Avalanche different?
So Avalanche, the protocol, has a couple of things that really distinguishes it. First, the consensus protocol is a different type of protocol. Most blockchains' consensus protocols are either the classical or the Nakamoto consensus. Avalanche is a random sampling method. Very few consensus protocols do that. And that gives it a functionality of what we call instant settlement, instant finality. So when you pay for something, it settles at the same time. Very different from traditional world. If you pay something at your restaurant tonight for dinner, the restaurant doesn't get it till 30 days later. So settlement and payment happen at very, very distant times. Stocks, same thing, 2 days later. So that's one very distinguishing characteristic of it. The instant finality, the great scale, and the architecture creating what we call a subnetwork. A subnetwork is effectively us creating a blockchain as a service for developers. So if you guys are a developer out there and you need a certain execution environment, customized and for your specific purpose, this is perfect for you. Because if you're on the app layer or the dApp layer, you really don't want to really worry about the infrastructure stuff. If you're a gaming company, you should focus on creating the best game and getting users and not worry about the bridge or the underlying infrastructure that has led to some problems for certain people in that space.
I think the big elephant in the room today, I mean, I guess it's not an elephant because we've addressed it many times, is the FTX news. And I want to hear your take on how that will affect what you're building at Ava Labs.
Yeah, so how about how it's going to affect Ava Labs and how it's going to affect the space?
Yes. Beat me to it.
Why don't we address the macro in the space first and then how Ava Labs handles it from a bottom up. I mean, I think the saddest thing about this incident here, unlike the earlier versions of this, is that trust has really been sapped out of the system. This space was always viewed upon by non-crypto native people as having, not the best people in it. And this only feeds upon that. Unfortunately, it's not everyone like that in the space. There are people here who have mission to do things that are make technology better, make lives better, make everyone's world better, basically. And that's going to be pushed out a little bit. So the space needs to regain that trust in the next 2 or 3 years. I think the space really has to first do some self-reflection and self-thinking and remind each other the first principles of what crypto is all about. And one of those principles is transparency. So all the culprits of everything we've seen is the opposite of transparency.
Yeah. Well,
and then there's other things that the space needs to do to regain its trust.
So Ava Labs, you support a lot of startups in your ecosystem, and I'm wondering, what have you been hearing from them in terms of what are their biggest concerns right now about the news?
Yeah. So there's for every layer one, and I think Jackie talked to Nikhil, who serves developers. Layer ones need developers, and developers are entrepreneurs. So the problem with this funding, and the topic is funding, is how much does funding go down so that it doesn't incentivize great developers and entrepreneurs to come into the space. Most of the developers on layer ones are really, they're even pre-seed, Y Combinator style, or they're seed and at most A level investments. So there is no doubt, and I hate to say this, whether you're trying to get Silicon Valley money or trying to get crypto native funds from ecosystem funds or from actually crypto native VCs, there's going to be a slower, it's going to be a lower take rate in terms of success, and it's going to be a slower process. But I think you should remember that if you have a great idea, there are still players out there who want great developers or great ideas, and the innovation in the space will not stop. It's slowed down. Let's be honest with ourselves here. It's going to be harder for you to get money. Valuation is going to be a lot lower, but it's not dead. And in a weird way, it's actually okay, because now it's going to be like, who's really serious about this? Who really has something that's good? There is definitely money for great ideas and people who are really dedicated and serious about what they need to do.
So a lot of VCs got burned in this whole incident, and I'm wondering how you think the VC funding landscape for Web3 startups will shift. Are we going to see different types of VC firms coming in? Are we seeing certain types of VCs pulling back? So
call it recent crisis, or the series of crises in this space, you were seeing Web2 VCs starting to get more and more involved in this space. So fundamentally, there are two types of mentalities out there. If you're a Web2 type VC and you want access to this space, you usually did it in equity and in things that are what I call more infrastructure on the edge, where money touches the crypto world. Would that be like custodians? That'll be on-ramps. That'll be even data analytical type of platforms. So these are like companies that are very tried and true business models in Web 2. And then you also had it separate, which is like VCs and crypto native VCs that thought of themselves more than just VCs. They were part of the ecosystem. So when they actually owned tokens, they felt like they were users. They were also help provide liquidity into, to AMMs. So they really were not just investors, but they were also part of the community. I think the unfortunate thing is the Web 2 folks were moving towards the Web 3 type VC.
Yeah.
And now you just move them further away. The Web 3 people, there's a lot of unfortunate casualties. It had nothing to do with them, but there will be, unfortunately, a lot of them out of business.
There's a lot of entanglements in the space.
Too much intertwined stuff going on.
So if you're, a founder, or you're an aspiring founder or a builder in Web3 today, and you are very cash constrained, how are you advising the startups that rely on Avalabs and the Avalanche ecosystem? What are you telling them?
I think one thing to do is, first of all, find the ones that have good balance sheets and good treasuries, who are still doing strategic investments. So Avalanche is still investing in their ecosystem fund. Due diligence is going to be longer. It's not as easy, for sure, just like everywhere else. But if you fit into the ecosystem somewhere from a strategic perspective, there is still opportunity. Avalanche obviously is known very much for DeFi and also getting real-world assets on chain, but there's a big effort in NFT as well as in gaming right now. We have such a long pipeline of both crypto native type gaming as well as AAA publishers who want to launch their own sub-network on Avalanche. So if you are in those areas, there is definitely a strategic value to whatever layer one. You should pursue that, because when the investor also has strategic value, you're getting far more than just money. You're getting relationship capital, not just transactional capital. And that's where in tough times you want someone to be there with you.
Yeah, so I guess circling back to the second part of my question earlier, how has the news affected your business? Yeah,
so luckily, Avalabs and Avalanche, the foundation, very little exposure to FTX. There was no lending to them, or Alameda, no lending to them, borrowing from them, no ownership of FTT. There was some counterparty risk because there was the Treasury had some access to them, and there was a market maker relationship, but it's very little. Really, the more of the effect is indirectly, and it would be the same for every other player. The space right now is in challenge mode. You're hearing the liquidity being sapped out of the system. Today, more news on Genesis.
Yeah.
it's the equivalent of like one of the largest exchanges, largest market makers, largest hedge funds, and with Genesis, largest banks, all going out at the same time. Those three entities touch almost every project and every business, and it extends into Web 2. You don't have the same leverage in the system as you had during Terra Luna or 3AC, because that's been taken down, but I think the tentacles here reach further out. So that's unfortunate.
Given your background, I want to get your take on this sort of, saying that people have been talking about, that crypto is evolving the same way that the traditional financial system did, and we're just going to see the space basically get regulated and turn into the equivalent. Do you think that's true?
Oh yeah, I mean, I think everyone's saying now, regulation is coming. Regulation is coming. Well, it was coming anyway. I think this does speed it up a bit or create more urgency, but there's so much that has to happen. First, there's going to be no legislation until they finish discovery. They've got to figure out what happened here. So you've got to have the people who are involved here go into Capitol Hill and testify. So there's a lot of research and discovery until they find out everything that caused this and what happened and what's not right before they even start legislating. So it's not as quick as people think, which I think is actually unfortunate, because it'll be easier to get retail investors back, developers to come in, and institutions to use the technology if there was more certainty. I would even say, bad regulation at this point is better than no regulation and uncertainty, because people are just going to sit back and wait. And you came from a TradFi background as well. The bank you used to work, they were experimenting with the space. They're probably saying we're going to hold off doing anything until we understand what the rules are now, even further. So that's the unfortunate thing, is like, it's good that in a weird way, again, nothing's good about this situation, but in a weird way, it'll create more urgency to create some certainty. And I think in the long run, again, that'll be better for everyone.
So DeFi is a big growth catalyst for you guys. And there's this tension that I've been observing, which is sort of, a lot of people are saying decentralization is a solution now. Yet, on the other hand, it seems like if regulation is imminent, that centralization, it's easier to comply with regulations as a centralized entity, right? You can make the choice not to do that, but that's a different matter. So I'm wondering if regulation really does come in, and if crypto continues to evolve like the traditional financial system, doesn't that take away some of the advantages that people cite to building in Web3?
It's funny. So you take this incident, and to a crypto native person, it's more evidence that you need a decentralized finance system. Because if you look at where the withdrawals did not halt and where everything went well, it was with the lending and borrowing dApps. In all three crises, they functioned. There was no withdrawals. Sure, assets came out of the system, but they did well. And in fact, some of the CLOBs and the DEXs and the AMMs are actually getting share in terms of exchange volume after this recent event. But at the same time, the same point, and that's a smaller subset, by the way, a larger group of people in the traditional finance world or anywhere else, when they look at the same incident, they look at and justify it as, this is more reason why you need centralization and regulators and more intermediaries in between. So I think what's going to happen is you're going to now have Web 2.5 first before you can do a Web 3, and then eventually, when the world is clearer, you'll go back to a Web 2 world and a Web 3 world, and then people will have a choice. Not everyone wants the self-custody. Some people will be happy to pay for the service of someone else looking after their assets and looking and securing it for them and dealing with it.
So you have been through a couple of different downturns. You were in 2008, you were deep in the weeds there. You were living through the last crypto bear market as well, working in this industry. I mean, is this, a lot of people are saying this is the end for crypto. How do you feel about that?
It's not the end for crypto. It's not good, but it's not the end for crypto.
What gives you faith that it's not?
Well, first of all, this is more than one cycle. It's not just crypto. I've seen in the late 90s to the early 2000s, you had obviously the dot-com boom that everyone talks about now, but people forget there was Enron, there was Adelphia, there was WorldCom. That was in the early 2000s. And then all of a sudden, 7, 8 years later, in 2007, 2008, you had the great financial crisis, you have Bear Stearns, you have Lehman, you have Madoff, which is obviously a complete scam. This situation, ironically, has bits and pieces of all of those things. And it is human nature, and people forget that FTX and Alameda are actually not blockchain crypto companies. They are centralized exchanges and hedge funds that happen to deal in the crypto space. So for me, again, it's more reason why decentralization should be the thing. It's going to be harder, but we've seen the financial markets come back, and we're going to see this market come back. There are a lot. The good news here, it's very simple why it's going to come back. It's because we did have a couple of really good years. There are treasuries on certain L1s and other companies. You've had many of the guests here today that are well capitalized, well funded, who have run rates of 3 to 4 years, maybe even more. And if they do it wisely and continue to build well, they're the ones that are going to come out of it and help lead this whole situation to a better state.
I want to sort of revisit the topic of, how this is going to affect Ava Labs, but I think that there are a lot of companies in the same boat as well. Yeah. I know NFTs have been a big growth catalyst for you all as well. Like you partnered with OpenSea, JPEG's marketplace got funding recently. And I suppose given that backdrop, if let's say average people, right, the everyday users lose faith in crypto, how is the NFT market going to continue to be a catalyst for growth?
Yeah. Okay, so a couple of things. The first, I never answered how does it affect Ava Labs. The roadmap is the same. It has not changed. We will probably be a little more cautious in terms of what we do and what we fund and how fast, and more diligence on deals that we do, and whether it's business development deals or whether it's investing in ecosystem projects. But the roadmap doesn't change. We will continue we're well known for DeFi. We'll continue to build up. It's a great time to be part of this NFT community because you get access to new community that's not involved in NFT yet. But the NFTs itself, there's really two types of NFTs. There are the collectible side, whether it's PFPs or tethered to a real piece of art in real life, and then there is the utility stuff.
Right.
The utility stuff is gonna, whether it's fan engagement, whether it is loyalty points or whatever, that has a purpose and it's going to continue to go. I think the collectible side will see a big hit from a pricing perspective, but
has been.
Art's been around for a long time. People still want to collect things at some point, so it will come back in a different way, different shape, maybe more different artists come in, but it's not completely dead. That'd be like saying art is going to die.
A lot of founders are struggling right now, obviously. What would you say to founders right now who are running crypto or Web3 companies who are either fully unable to raise capital or maybe aren't able to raise capital at a valuation that's acceptable to them?
Yeah. I mean, I would love to say I can say something great and you guys would be really happy and run out of this room and say great and cheer you up that way. Part of my job as someone in the industry is to inspire all. But I think at this point, it's really important that people remind themselves the why. Why are they doing what they're doing? If you came into this because you were part of the hype cycle and you were just doing it for money, I don't know what to tell you. We all want to make money, clearly, but if you came in with a specific mission and a purpose and doing something you love, don't forget that side of the formula as well. And that faith in what your mission was and why you did this and the passion you had is what will allow you to figure out a way to get out of this other side of the tunnel where the sun is really bright.
From a business and operational perspective, are there any pieces of advice you have for, again, founders who are struggling to raise capital right now? How do they make it
through? If you have not raised capital, if you have raised capital, I think you got to look at your burn rate and try to make that last as long as possible because there's so much uncertainty as to how this winter is going to play out now. If you have not raised, if you can bootstrap, if you can find the ecosystem that needs what you're building, go to them. Valuations are down, like you mentioned, and the dollars or the size of the tickets are down, but it's not gone. If you are motivated, passionate, and you have a real fit with someone in a certain ecosystem, some portfolio of a VC company, it's not like it's not there. Don't forget, there was 2020 and 2021. There was a lot of money raised in Web 2 as well as Web 3 VCs. The Web 3 is hurt right now, but even them, there are still a lot of newer funds that were raised recently that have not fully deployed. So there is capital out there. It may not be put to work right away, but it is still there. If we didn't have a 2020 or 2021, or even in Web 2, the run from 16 to 2020, then it's a different story. Then you go back to the old school garage type of builder, but entrepreneurship has kind of been institutionalized. And, I was just talking to Gary Tan, who's the CEO of Y Combinator. They're still doing things. So it is out there. It's not going to be easy, but you have to find the right place to go.
I want to see if maybe you can help share some guidance on quantifying some of what you're talking about. From your perspective as an investor, like how much have you been seeing valuations drop?
Oh, yeah. So, well, here are the numbers from Web 2 stuff. Like, early valuations I've seen, we had like Series A stuff peaking out like, 70 million pre-money and stuff from Web 2 stuff. And
I imagine it's worse in Web 3, right, at this point?
Actually, they've held up better because those markets move slower because it's not like an active liquid market. I mean, there's a disconnect. Well, that's definitely cut in half probably. By definition, most of the projects are circulating supply of fully diluted value supply in the space. I think the same project probably in 2021 was getting valuation of probably 75. If they were getting 75 to 100 million in your circulating or fully diluted value, right now I think that's probably closer to like 30 million. Check sizes before in Web3 for these token projects were probably anywhere from 2 to 4, and now they're probably closer to 1. I don't know if that helps, but
no, it does. And I was also going to ask the follow-up of how significantly have you been slowing your pace of investment?
It's not like slowing for the sake of slowing. It's more, I think we've all learned from this, like serious due diligence has to be done even at early stages.
Yeah.
And that takes time. I mean,
so you haven't slowed down?
Philosophically, you haven't slowed down. But, I think, everyone was caught up.
Because due diligence takes time.
I mean, you're optimizing for different things. You were optimizing for speed because the entrepreneur had many choices. So if you didn't do it, someone else did it. Now there are, sadly, I hate to say this, there are just fewer choices out there. So the person giving the money has more freedom to take time and to ask questions and to really dig and to really figure out if there is a natural fit.
Thanks, John. I think that's all the time we have. No kind of a somber note to end things on, but I appreciate you taking the time to chat with me.
Thank you, Anita.
Thanks.